It was in 1990 when Peter Lynch, who is also regarded as one of the most successful investors in America, retired as manager of Fidelity Magellan Funds. Just to give you some background, Fidelity Funds is known as America's biggest and by far the most successful stock trading mutual fund. If you'd look up on Google and search top 10 mutual funds in the United States, then you would definitely find Fidelity at somewhere top on the list. So from 1977 to 1990, Peter Lynch acted as manager for the fund, and to everyone's surprise, he brought an astonishing 2,800% profit single-handedly through stocks. And he didn't focus on timing the market, but instead paid all of his attention to picking the right stocks. Of course, we cannot promise you the same results, but one thing is for sure, we can learn a lot from his wisdom. So if you're one of those beginner investors trying to navigate happenings in the stock market, this might be the ultimate guide for you. In this video, we are going to bring Peter Lynch's investing wisdom to you guys, and you're going to learn what is the best possible way to go about finding stocks, and what do we need to know about market crashes, what are those important categories of stocks that every investor should know about, and what is the ultimate rule of price and earning. And to cap it all, what are those balance sheet tricks that can provide you with an advantage over other investors, and what do we need to know about risks coming with stock market investing? Let's first look at the performance of different investment equities for the past 25 years and see for ourselves why Peter Lynch's investments revolved around only stocks and not indexes or commodities or bonds, etc. After balancing out good and bad performing years, the National Stock Exchange averages a return of 22% per year. Government bonds average at 12 to 18% returns per annum, and bank FDs are around 6 to 8%. Now you might notice that the difference isn't a gigantic one, but once you're exposed to the power of compounding, you'll view this 22% with a completely different perspective. Suppose you're investing some 500 rupees per month, starting from when you were 20 years old. Then, by the time you would reach your retirement, you're going to end up having around 64 lakh if you had wisely chosen to invest in the stock market and picked the right stocks. But wait, let's say you're like, what if the economy crashes and the market drops? I would rather invest my money somewhere more safe, like bank FDs. To answer that, I'd suggest that it is much better to not invest anywhere whatsoever, since you could at least have the freedom and access to spend those rupees for the sake of your happiness. क्योंकि अगर FD में पैसे invest कर दिए, तो number one, you can't have free access to it. अगर जरूरत भी पड़ी तो आप उसे touch नहीं कर सकते, वरना बैंक penalty लगा देगा. And number two, जो 6 to 7% profits हाथ आएंगे, वो भी किसी काम के नहीं, क्योंकि इससे ज्यादा तो हमारे देश का annual inflation रहता है. So the moral of the story is, invest करना है तो ढंग की जगह invest करो, वरना ना ही करो तो बेहतर है. According to Lynch, investing is a personal thing. You have to do it by yourself. You don't do it with a committee. You have to be able to have the emotional strength to stand the volatility of the market and stocks in general. The key organ here is not the brain, it's the stomach. Do you have the stomach for it? Do you have the patience for it? According to Peter Lynch, if you know something that will drive a company higher, then you know something that will drive the company's stock higher, sooner or later. But you can't just guess at it. You've got to have your reasons. For example, costs of a certain company are coming down. Then you might have a chance to buy a great stock that is undervalued at the moment. Similarly, if you think that the new product of a certain company is going to be a big hit, then it might just be it. Research is all about knowing a company's story and an idea about why the earnings should go up or down. It doesn't mean spending hours and hours in the library skirmishing through various journals, going through those SEC filings, or spending time fiddling with a calculator. For example, when Peter Lynch owned Chrysler, which is one of the big three automobile manufacturers in the United States and also the biggest position in his fund, he arrived at an idea. Why not conduct a survey? Why not ask the consumers of Chrysler what do they think about their vehicle? So he went at a sports event and found people who owned Chrysler's minivans, because at that time they only used to make minivans. So he looked for people who owned Chrysler's vehicles and asked them, what do you think about your minivan? What do you like about it? And how likely is it that your next vehicle would also be a Chrysler? People would respond by saying, well, it's a little underpowered. They only have a 4-cylinder engine. And Peter Lynch already knew that the company was working on a 6-cylinder engine. So in some sort of way, Peter could predict how the market is going to react when Chrysler Automobile would reveal their six-cylinder engine. Similarly, things could have gone the opposite way if the company had been planning to shrink-launch a less powerful engine for its consumers. Research starts with the things you know, the things which provide you an edge. For example, if you're a mechanic or a technician, you know about the best tools you have at your disposal. Similarly, if you're an engineer, you can see how new technology can save money for people. According to Peter Lynch, the amateur investor can probably follow between 5 to 8 companies. They could lecture in these 5 to 8 companies. They know them very well. There are 10,000 to 15,000 public companies in the United States. There's a lot more overseas, so you don't have to be experts on a lot of companies. You just have to know a few of them very well. A lot of investors refrain from investing in stocks simply because they think that the market is too volatile and it's a gamble to invest in stocks. Now, we need to understand that actual bad economic news, rising interest rates, elections, political instability, wars, and other factors can hinder the market's growth and lead to a crash. But many people try to predict these market crashes and design their investment strategies accordingly. If you're one of those investors peering over those economic charts, statistics, and graphs just to predict when the next market crash is coming, then you're wasting your time. No one can predict the market. For example, in the 20th century, there were more than 50 declines of more than 10% in the share market. But among those 50, there were 15 of 25% decline or more. So what we can conclude is that after 2 years, the market falls 10%. And similarly, after every 6 years, the market falls 25%. That's what every beginner investor needs to understand, the nature of the market. It was in 1990, the Iraqi President Saddam Hussein went to Kuwait, which is probably the biggest oil exporter throughout the world. The entire region was put into chaos. Recessions were seen in the National Stock Exchange as well as the Bombay Stock Exchange. Now, when it comes to the corporate sector, the companies had absolutely nothing to do with the war, but they were struggling in 1990. The stock market plunged from 3,000 to over a 20% downfall. Now, for some of the investors, this was alarming, and they started to get rid of their holdings. While for others, it was an opportunity to buy some quality companies at cheap prices. What we as investors need to understand is the fact that when we buy a stock, we are actually buying into the company. When the company rises, so will the price of its stocks. And similarly, when it undergoes financial unrest, the stock price will plunge. There are thousands of companies listed in the stock market, and classifying them in categories is the best way of developing an understanding of business models. The categories tell you what you need to be looking for and ask about certain stocks. According to Peter Lynch, there are 5 categories. The first one would be fast growers. The second one would be slow growers. The third one is cyclicals. 4 will be asset plays. And the 5th is turnarounds. Every investor needs to remember that categories are not hard rules, they're guidelines. You can always use these stock categories to help you navigate the market in a better way, but don't let them confine your research. There are some companies which cannot be categorized due to their peculiar nature, while on the other hand, you may see companies in the Indian stock market which are classified into more than 2 categories. And moreover, there are companies that are classified in 2 categories at the same time. So everything depends on your understanding of certain things. Now, the price of a stock is directly related to its earnings. For example, if the graph of a company's earnings over time is going up, the price of its stock will go up as well. Similarly, if its earnings go from normal to great, the stock is going to rise. If it's going from better to excellent, it's going to undergo another rise. Even if you're a genius with some genie in your pocket, you still cannot predict a company's earnings. But in India, there's a whole army of people who make such predictions and end up losing their money. If you understand a company, you should know how its earnings rise. For example, Tata Steel is a company that has shown great growth in the past few years. And that is a good reason to invest in it. But there will always be a slight chance of hindrance in growth. Price to earnings ratio is something that most financial pundits make very complex, but it's very simple. Let us just say that a company is selling for 100 rupees per share and earning 10 rupees. Its price to earnings ratio is a multiple of 10. Long story short, the time required by the company to earn back the initial investment made by an investor is termed as its PE ratio, taking the earnings of a company to be constant over time. Now the question arises, why should we look at PE? According to Lynch, it could provide us with an insight into the stock. It can tell us if we have bought the stock at the right price or not, and much more. With a hot PE, the stock will be expensive relative to the company's future earning power. Similarly, lower PEs are characterized by cheaper stocks. Another important aspect that can tell you a lot about a stock is its balance sheet. The balance sheet of a company can help you answer many important questions revolving around the company, such as how much of a debt does it have? How much cash does it have? Everything can be estimated by peeking into the balance sheet and other financial statements. There's nothing scary about the balance sheet, and no story is complete without a look into it. The underlying concept that a balance sheet can help you understand is that it can tell you everything a company owns. Its assets are listed on one side. On the other hand, you find everything the company owes, that is, its liabilities. The difference between what it owns and what it owes is the equity it holds, also known as the net worth of a company. A company's financial situation can tell you a great deal about its situation, and this is the reason Lynch terms financial statements as the most important factor in choosing stocks to invest in. Do you want us to make a separate video on balance sheets? And how are you guys planning to utilize Lynch's wisdom? Let us know in the comment section below. Make sure you press the like and subscribe button, and we'll see you in the next video.